The modern story of swap lines begins with scarcity. Outside the United States, banks, corporations, and governments borrow heavily in dollars because they want access to the world's reserve currency. They issue dollar bonds, sign dollar-denominated trade contracts, and hedge risk through dollar derivatives. In normal times, this is easy to manage. Offshore dollar markets are deep, and institutions can roll over their funding with little drama. But when panic hits, when lenders suddenly hoard cash, when trust evaporates, dollar funding can disappear almost overnight. It is in those moments that foreign central banks turn to the Federal Reserve, asking not for charity, but for access to the one thing only the Fed can create at will: fresh dollar balances. A swap line is, on its face, a simple legal agreement. The Fed and a foreign central bank exchange currencies at a pre-agreed rate. Dollars flow out from the Fed, and the foreign central bank lends its own currency in return. On the Fed's books, this is not a giveaway but an asset, secured by the foreign central bank's promise to reverse the transaction later at the same exchange rate. When the crisis passes, the swap unwinds. The foreign central bank returns the dollars, the Fed returns the foreign currency, and the entries vanish. No permanent flow of funds remains. But in between those two steps, something remarkable happens. The foreign central bank uses those borrowed dollars to lend to the banks in its own jurisdiction, stabilizing their funding and preventing a scramble that could ricochet back into U.S. markets. From the perspective of a local banker in Europe or Asia, the process looks almost magical. One day, dollar funding is tight, interbank markets are freezing, cross-currency funding costs are spiking, and there is talk of rationing. The next day, after an announcement from the central bank, dollar auctions appear. Suddenly, there is a channel to borrow dollars against eligible collateral at a known rate. The immediate panic subsides. The institution never deals directly with the Fed. It interacts with its own central bank, which now acts as a conduit for emergency dollar liquidity. The pipes are invisible, but the effect is palpable. Behind the scenes, a small group of officials in Washington and in a handful of foreign capitals have opened the valves. Access to these valves is not universal. Swap lines are not treaty obligations or automatic rights. They are relationships. Over time, a hierarchy has emerged. At the top sits a core group of central banks, those of major advanced economies that have standing, unlimited dollar swap arrangements. Below them are temporary or crisis-based lines extended to selected emerging markets when conditions warrant. Many countries sit outside the system entirely with no direct pipe into the Fed's balance sheet. For them, dollar scarcity can be existential. They must rely on their own reserves, on ad hoc bilateral arrangements, or on the goodwill of institutions that do have swap access. In effect, the network of swap lines sketches an informal map of dollar privilege and exclusion that does not match any formal alliance structure, but is no less powerful for its informality. From the Fed's vantage point, there is a plausible technocratic justification for this architecture. Dollar markets are global, and stress abroad can rebound into the United States. Supporting foreign central banks in moments of acute funding strain is presented as an act of self-defense. By preventing a dollar panic in Europe or Asia, the Fed protects U.S. financial institutions, exports, and asset prices. The design of the swaps, fully collateralized, reversible, and temporary, allows officials to argue that they are not taking on foreign credit risk in the same way a direct loan to a foreign government would. The transactions are framed as plumbing maintenance, not foreign policy. But the practical consequence is that, in moments of crisis, the Fed chooses which parts of the world get dollar oxygen and which are left gasping. Over the past 2 decades, this hidden network has been tested repeatedly. During the global financial crisis, dollar funding dried up across Europe, where banks had built massive portfolios of dollar assets funded with short-term wholesale borrowing. As markets seized, the European Central Bank and the Bank of England could not, on their own, manufacture dollars. They could print euros and pounds, but that did not satisfy dollar liabilities coming due. Through swap lines, the Fed effectively extended its lender of last resort function overseas. Dollar auctions conducted by foreign central banks, backed by Fed swaps, became a crucial tool for preventing a wave of failures that could have overwhelmed both foreign and American institutions. Official communiques spoke of technical measures and coordinated action. Behind those words lay a blunt reality. Access to Fed dollars had become the deciding factor between stability and collapse for large swaths of the global banking system. The pattern repeated in different form during subsequent crises. Whenever uncertainty surged, whether due to sovereign debt turmoil, geopolitical shocks, or a sudden stop in capital flows, the same questions resurfaced. Which central banks had prearranged dollar lifelines? How large were the lines? Under what terms could they be tapped? Markets learned to read between the lines of official statements, parsing phrases for hints that swap arrangements might be expanded, extended, or newly granted. Even before any dollars changed hands, the expectation of support could calm funding markets. A whispered assurance that a line would be available if needed could be as powerful as an actual auction. In this way, the swap network became not just a mechanical channel for liquidity, but a psychological anchor, shaping perceptions of which jurisdictions were inside the dollar safety zone. That safety zone functions in practice as a kind of quiet empire. Traditional empires relied on armies and governors. Modern monetary influence works through balance sheets and backstops. Countries whose central banks enjoy standing swap lines are effectively integrated into the inner circle of dollar liquidity. Their banks know that, in a crisis, the plumbing exists to funnel in dollars at scale. Their governments know that disorderly devaluations and funding panics are less likely, because the central bank can lean on its relationship with the Fed. Conversely, countries on the outside must hoard reserves, accept harsher market discipline, or seek alternative arrangements that are often more fragile. The map of swap lines thus creates concentric rings around the Fed's balance sheet. A core of fully connected allies, a periphery of occasional partners, and a large outer world left to fend for itself. This structure also turns the dollar into a potent geopolitical tool, even if officials studiously avoid framing it that way in public. Granting or expanding a swap line can be read as a vote of confidence, a signal that a country's institutions are trusted and systemically important. Withholding such a line or letting a temporary arrangement lapse can be interpreted as a subtle rebuke or as a decision that the risks outweigh the benefits. In extreme scenarios, the mere hint that access to dollar liquidity might be constrained can influence domestic policy debates in foreign capitals. Few finance ministers want to be blamed for alienating the one institution that can provide unlimited dollars in a crunch. The decisions are taken behind closed doors, couched in technical language, but they carry the weight of strategic choice. Yet the power that swap lines embody comes with its own constraints. The Fed is not a foreign ministry. Its officials are tasked, at least formally, with maintaining domestic economic stability, not conducting diplomacy. Every expansion of the swap network raises questions about mandate and accountability. Why should unelected officials in one country determine the global hierarchy of dollar access? How are those choices scrutinized and by whom? At the same time, refusing to act can be just as consequential. In a world where dollar liabilities are woven through balance sheets from Frankfurt to Seoul, a decision to keep swap lines narrow is effectively a decision to accept higher odds of global turmoil that could rebound on the United States. The hidden empire of dollar liquidity is thus both an instrument of influence and a burden of responsibility. In the background, the basic tension remains unresolved. The dollar's dominance ensures that crises anywhere are often dollar crises. Swap lines are the improvised wiring that allows the Federal Reserve to extend its reach beyond U.S. borders when fires break out. They operate through ledgers and legal documents, not tanks or treaties, but they shape the fate of banks, currencies, and governments across continents. To those who receive their support, they are a vital lifeline. To those left outside, they are a reminder that the global monetary order is not a level playing field, but a landscape structured around a currency whose ultimate guardian sits in one city, behind one set of closed doors. In quieter moments, far from the panic of crisis headlines, swap lines still cast a long shadow over how global finance is organized. Banks and treasurers plan their funding strategies with an implicit map in mind. Which jurisdictions can summon dollars from their central bank and which cannot? This influences where multinational corporations choose to book operations, where global banks place regional hubs, and how investors price risk in different markets. A country plugged into the swap network enjoys an invisible subsidy in the form of lower perceived funding risk, even when no active drawings are taking place. The architecture of the hidden liquidity empire shapes decisions long before any emergency announcement ever hits the news. The presence of swap lines also distorts traditional measures of sovereignty. On paper, each central bank is independent, responsible only to its own legal framework and domestic political institutions. In practice, any central bank that depends on the Fed for dollar liquidity has to think carefully about how far it can diverge from Washington's preferences without jeopardizing that relationship. This does not mean that every policy choice is dictated from abroad, but it does mean that the outer boundary of acceptable behavior is partly defined by the willingness of the Fed to keep the pipes open. Monetary independence begins to look conditional, especially for those economies whose banks and corporates are deeply entangled in dollar funding markets. For countries marginalized or excluded from the swap line club, the system sends a different message. They learn to live in a world where dollar access can never be taken for granted, and where building large foreign exchange reserves is a form of self-insurance against the possibility of being cut off. This often means sacrificing domestic investment and social spending to accumulate holdings of U.S. Treasury securities and other safe dollar assets. Ironically, in trying to protect themselves from the vulnerability created by the dollar's dominance, these countries end up reinforcing that dominance by recycling their savings back into the very system that leaves them exposed. The absence of a swap line is not just a missing pipe, it is a structural disadvantage written into national balance sheets. The opacity of the swap system adds another layer of unease. While major facilities are announced, the deliberations behind who gets access, in what size, and under what conditions are largely hidden from public view. Legislators, journalists, and ordinary citizens rarely see more than sanitized summaries. The technical language of central banking, terms like temporary liquidity provision and market functioning, masks the concrete reality that some institutions in some countries receive time-sensitive life-or-death support while others do not. In a democratic age that prizes transparency, this quiet concentration of power behind closed doors stands in stark contrast to the open rituals of rate decisions and press conferences. Over time, awareness of this hidden empire of dollar liquidity is beginning to seep beyond specialist circles. Scholars, activists, and even some policymakers have started to ask whether a global system so dependent on the discretionary choices of one central bank is ultimately stable or legitimate. Proposals for alternative reserve currencies, regional safety nets, or digital payment systems, all in one way or another, respond to the same unease. The sense that the world's financial lungs rely on oxygen controlled by a single institution. For now, swap lines remain the emergency wiring that keeps the dollar-based order intact when stress hits. But every crisis that requires their activation also reminds the world that beneath the surface of technical operations and balance sheet entries lies a stark question about power. Who has it, who does not, and what happens when the next fire burns hotter than the last. Продолжение истории, еще 6 абзацев, американский английский. The evolution of swap lines also reflects changing geopolitical realities that are rarely acknowledged in official communications. In the early decades after World War II, dollar arrangements tracked closely with formal military and political alliances. Countries in the Western Bloc enjoyed closer financial integration with U.S. institutions, while those outside faced barriers. Over time, economic logic and systemic risk calculations began to complicate that neat picture. Emerging economies grew large enough that their dollar funding stress could ripple through global markets, regardless of their political alignment. The Fed found itself in situations where extending a swap line to a country with complicated diplomatic relations was justified not by friendship, but by the cold arithmetic of financial contagion. The result is a system that mixes strategic preference with crisis pragmatism, creating ambiguities that neither side finds comfortable to discuss openly. Another dimension of the swap system is its role in sustaining patterns of trade and capital flow that might otherwise have adjusted. When foreign banks and corporations know they can ultimately access dollar liquidity through their central bank's Fed connection, they are more willing to build up dollar exposures that would be riskier in the absence of such a backstop. This encourages continued reliance on dollar invoicing, dollar borrowing, and dollar-denominated contracts, even in regions where other currencies might be viable alternatives. The swap network, in this sense, acts as a stabilizer that perpetuates the very imbalances it is designed to manage. It becomes a self-reinforcing loop. Dollar dominance creates vulnerabilities that require Fed support, and that support in turn makes it rational to deepen dollar dependence. For the Federal Reserve itself, the expansion of its implicit global responsibilities has not been matched by a corresponding expansion in accountability structures or formal mandates. The Fed's legal charter speaks of domestic objectives, yet its balance sheet and policy choices now carry planetary consequences. Swap lines have drawn the institution deeper into that contradiction. Each time a crisis forces the Fed to stabilize foreign funding markets, officials reaffirm that their primary obligation is to U.S. economic stability. But the practical effect is that the Fed functions as a de facto global central bank for dollar liquidity, operating without the political legitimacy or institutional framework that such a role would normally require. This mismatch leaves both the Fed and foreign central banks in an uncomfortable limbo, exercising power without clear boundaries or accountability. The technical design of swap lines also reveals important assumptions about trust and hierarchy. Swaps with major advanced economy central banks are standing and unlimited, reflecting a judgment that these institutions are creditworthy, competent, and systemically critical. Swaps extended to emerging markets tend to be capped, temporary, and hedged with additional conditions. The distinction is rarely articulated in stark terms, but it is embedded in the legal agreements and operational limits. A standing line communicates confidence. A temporary line communicates caution. For the receiving countries, these distinctions matter profoundly. Being granted a standing swap is not just a technical facility, it is a mark of inclusion in the inner circle of global financial governance, with all the symbolic weight that carries. The future of this system is far from certain. As the global economy's center of gravity shifts, and as digital currencies and alternative payment systems gain traction, the mechanisms that worked in the 20th century may face new strains. Some countries are actively exploring ways to reduce their dependence on dollar funding, building regional liquidity arrangements, or experimenting with currency swaps denominated in their own money rather than routing everything through the Fed. Whether these alternatives can scale to provide the reliability and depth of dollar markets remains an open question. But the very fact that such projects are underway signals a recognition that reliance on swap lines granted at the discretion of one central bank is a vulnerability as much as a safety net. Ultimately, the hidden empire of dollar liquidity embodied in swap lines reflects a broader truth about the international monetary order. It is improvised, unequal, and fragile in ways that formal institutions and treaties often disguise. The Fed did not set out to become the lender of last resort to the world. It was drawn into that role by the scale of dollar use and the interconnections that followed. Swap lines are the duct tape holding that arrangement together, flexible enough to stretch in emergencies but lacking the transparency, accountability, or permanence that a truly stable system would require. For now, they work because all sides have more to lose from letting them fail than from living with their contradictions. But every new crisis tests the limits of that pragmatic bargain, and every intervention leaves behind the question of how long an improvised solution can bear the weight of a global currency system.